All right, for more on the latest market moves, let's welcome in now Dennis DeBusschere, president at 22V Research. Dennis, it is good to see you. I thought it was interesting, Dennis. You said that there's this plausible chain of events you're telling your clients, Dennis, that could lead to a market downturn. I'm just curious, Dennis, what is that possible chain of events you see?
Yeah, thank you. So that chain of events would be a much hotter than expected CPI that would get the Fed to pause and then make it clear that the cutting cycle was uncertain at best in the future, meaning through the course of 2025. So that would be that plausible chain of events. I want to make it clear we're not calling for that, but that's what you probably need, and that would probably get you to a sustained rotation out of the recent winners. Right. So we've seen a scenario where the market has gone up, obviously post the election, led by a lot of growthier names. So if you were to see something like I just outlined, you'd probably see a pretty significant rotation out of the winners, which would take the market lower.
And so if that isn't your base case here, what do you think are the biggest sort of potential risks, either between now and the end of the year, or, let's sort of stretch it into the beginning part of 2025 also?
Yeah, so the biggest risks, unfortunately, and when I say unfortunately, they're just hard to forecast in real time, are shocks, right? So we're in a scenario now where the economy is in a durable expansion. Inflation doesn't appear to be a major problem. You should expect the expansion just to continue unless there is a shock to financial conditions. That could happen with a very unexpected Fed or inflation print that I just mentioned, or that could happen from a policy side. Maybe tariffs end up being a lot more onerous than what people are expecting. But beyond that, it's really just outside shocks, which are very difficult to position a portfolio for. You're thinking more about hedging positioning than actually positioning your portfolio of shocks that may or may not happen.
Dennis, in my inbox this morning, more notes from strategists bringing up sentiment. And their point was to their clients, Dennis, sentiment, one of those variables, it doesn't matter until it does, right? But from a short-term trading and contrarian perspective, they didn't love what they were seeing in terms of this kind of rising bullish sentiment. And I'm just curious how you're thinking about that.
I very much appreciate sentiment as far as a contrarian indicator, but to your point, you kind of need it with a catalyst with it. And that's why I mentioned that plausible scenario that could be a catalyst for a reversal in sentiment. But what are the odds that we're actually going to see a much higher CPI print? What are the odds that the Fed is going to signal much tighter financial conditions? They don't seem that high to us. So when you think about sentiment, it's just it's a little bit foolish just to assume it's going to reverse for the fun of it. Like, we're not in a game of sitting here forecasting like sentiment's overextended. I get it. That could lead to more severe than normal drawdown in risk assets. But like, just saying that, or positioning that for the fun of it doesn't seem like the best strategy.
Dennis, as you know, it's that treasured time of year when many of your colleagues on Wall Street come out with their 2025 end-of-year forecasts. I don't think that's part of your practice, if I'm not mistaken, but I'm curious kind of the direction you think we're going for 2025, and if you think we could potentially see double-digit gains, or that's behind us.
Yeah, so we'll have a forecast. We usually do it the first week of January once we know everybody else's. That's a nice sell-side trick. But beyond that, I would say it's essentially one of lower or more muted market returns. And I don't think we're out of consensus with that. So you should expect the market to have much more muted returns relative to the last 2 years, which, by the way, is not the most heroic thing to say in the world. Obviously, +2 + 20-year returns. To say that we're probably not going to see that again is, again, not a heroic thing, but does get us focused on internals of the market and are the laggards of the last 2 years going to catch up? And those laggards are very clearly value and small caps. And that's the question investors are asking. Do they just keep on running with these winners, or do you position for a rotation and kind of not too focus on the overall market?
With small caps, Dennis, you noted, you expect small caps to outperform next year, but you argued it's sort of a show me story. What do you mean by that?
It's a show me earnings story. So when you think about small caps this year, they're up, but they've obviously lagged, and it's been all multiple expansion, whereas the S&P had multiple expansion plus earnings growth. So next year, small caps earnings are expected to be up roughly 20% relative to large caps, roughly up, call it 14.5%, which is great for small caps on a relative basis, but you actually got to see that happen, right? It has not paid to front run that. And given how much multiple expansion you've already seen, you probably need to see those small cap earnings actually come through. And there are questions around margins next year. There are questions around the impact of tariffs to the extent that we get them in an onerous way or not. And so, you'll probably need to see that proven out because people have been burned on the small cap trade a number of times where it hasn't actually worked out because the earnings just were not there to backfill.
So let's talk about the other choices then, Dennis. Do you just stick with what's been working, which has largely been large cap tech? Or do you buy into the broadening narrative, just not broadening as far down as small caps, perhaps?
Yeah, I buy into the broadening narrative over time because our call is those earnings will actually come through over the course of 2025. But if we can segregate the market into the longer term, say what's going to happen over 2025 and what's going to happen over the next 3 months, being short large caps over the next 3 months doesn't seem like the best idea. Well, maybe it's never the best idea. I should have that tattooed on my forehead. Don't short monopolies. But they're great companies. The backdrop is strong from an economic point of view. Inflation is muted. Not the type of backdrop where you want to be negative on growth unless the earnings picture starts to change on a relative basis. So I think that happens. We think that happens next year, but we're not going to see anything on that front for the next 2 to 3 months. So why would they not keep on working?
All right, fair enough. Dennis, great to see you. Thank you so much. Come back and see us when you do have that 2025 forecast in January. We'll be looking for it. Appreciate it.